Imagine you spent 2 years saving every dollar you could. You skipped vacations, you ate at home, you said no to things your friends were doing. All of it, every sacrifice pointed toward one single goal, owning your own home. And then, in February of this year, mortgage rates finally dropped below 6% for the first time since 2022. You felt it, that moment of relief, that feeling that maybe, just maybe, the door was opening for you. And then a war broke out in the Middle East, and within days, your dream got more expensive again. Right now, in April 2026, the average 30-year fixed mortgage rate has risen for the fifth straight week. It is sitting at 6.46% and climbing. Refinance applications have crashed 17%, purchase applications are falling, and millions of Americans who were finally ready to buy are being pushed back to the sidelines again. But here's what nobody is explaining to you. It is not just about interest rates. It is not just about the housing market. What is happening right now is a chain reaction that started thousands of miles away in the Strait of Hormuz and ended up directly inside your monthly mortgage payment. And by the end of this video, you are going to understand exactly how that happened, exactly what it means for your financial future, and exactly what the smartest move is for you right now, whether you are trying to buy, trying to refinance, or simply trying to protect what you already have. Stay with me. This one is personal. Let's start with James. James is 34 years old. He lives in a 2-bedroom apartment in Dallas, Texas with his wife and their 5-year-old daughter. For 3 years, James has been doing everything right. He built his credit score as 720. He saved $40,000 for a down payment. He got pre-approved. He was ready. In late February 2026, his mortgage broker called him with news he had been waiting years to hear. Rates had just dropped to 5.98%. For the first time in years, a 30-year mortgage was under 6. His broker said, "James, now is the time." James and his wife spent that weekend looking at homes. They found one they loved, a 3-bedroom in a good school district, $385,000. With their down payment and a rate of 5.99%, their monthly payment would be around $2,070. Tight, but doable. Then Monday morning came, and everything changed. The United States and Israel launched military strikes on Iran. Oil prices exploded. Bond markets went into chaos, and by Tuesday, James's broker called again, but this time with completely different news. Rates had jumped to 6.12% overnight. By the end of that week, 6.24%, and now 5 weeks later, 6.46% and climbing. On that same $385,000 home, James's monthly payment is now $2,185. That's $115 more every single month, $1,380 more every single year. Over the life of a 30-year loan, that's over $41,000 more that James will pay for the exact same house because of a war he had nothing to do with. James didn't do anything wrong. His credit is the same, his savings are the same, his income is the same, but his dream just got $41,000 more expensive in 5 weeks. And James is not alone. There are millions of Jameses across America right now, sitting in apartments, sitting in their parents' homes, sitting on down payments they spent years building, watching that door slowly close again. So how exactly did a war in Iran reach James's wallet? Because this is the part that will genuinely change how you see the financial world, and once you understand it, you will never look at the news the same way again. It all starts with something most people have never thought about in their lives: the bond market. When you apply for a mortgage, your bank doesn't just make up an interest rate. That rate is directly tied to something called the 10-year U.S. Treasury yield. Think of it like a master dial. When this dial goes up, your mortgage rate goes up. When this dial goes down, your mortgage rate goes down. Almost automatically, almost instantly. So the question becomes, what controls that master dial? Bonds, specifically whether investors around the world want to buy them or sell them. Here's how it works. When the world feels calm and stable, investors buy U.S. Treasury bonds because they're safe and reliable. When lots of people are buying bonds, yields fall, and when yields fall, mortgage rates fall. But when the world feels dangerous, when inflation is rising, when oil is spiking, when the future feels uncertain, investors start selling bonds because a bond that pays you a fixed 4% per year suddenly looks terrible when inflation is running at 5 or 6%. You're actually losing money in real terms by holding it. So they sell. And when everyone sells bonds at the same time, yields spike. And when yields spike, mortgage rates follow immediately. Now here's where Iran comes in. On February 28, 2026, the United States and Israel launched military strikes on Iran. Within hours, Iran retaliated by targeting oil infrastructure across the region. The Strait of Hormuz, that narrow waterway carrying 20% of the world's entire oil supply, was suddenly under threat. Oil prices exploded. Brent crude surged past $100 a barrel, then $115. Inflation fears reignited instantly across global markets. And here is the brutal math that hit James without warning. Rising oil prices mean rising inflation. Rising inflation means bond investors start selling because their fixed returns get eaten alive by rising prices. Massive bond selling means yields spike, and spiking yields mean mortgage rates jump immediately. And jumping mortgage rates means James's monthly payment goes up by $115 before he even had a chance to sign a contract. The chain reaction from a missile strike in Tehran to James's mortgage payment in Dallas took less than 72 hours. That's how connected the modern financial world is. That's how a war you're not fighting in a country you've never visited about a conflict you didn't start can reach directly into your bank account and change the number on your monthly bill. Now, here is where it gets even more frustrating, and this is the part that nobody is talking about. Mortgage rates had been falling all through late 2025 and early 2026 for a reason. The economy was softening, inflation was cooling, the Federal Reserve was signaling rate cuts were coming. Hope was building in the housing market for the first time in years. That 5.98% rate in February was not an accident. It was the result of months of economic progress, and it carried real emotional weight. Economists call it a psychological threshold, a rate starting with a 5 that signals to millions of Americans that now might finally be their moment. And then in a single weekend, all of that progress was erased. As of this week, the average 30-year fixed mortgage rate is 6.46%, the highest level since September. Pending home sales have fallen. Purchase mortgage applications are down 3% week over week. Refinance applications have collapsed 17%. The spring housing market, typically the busiest and most important season of the entire year, is now sitting in a holding pattern. Buyers are doing new math. Sellers are staying put. And the dream of homeownership, which was finally starting to feel real for millions of Americans, is once again starting to feel out of reach. But here is what I want you to hear clearly, because this is the most important part of everything I'm going to say today. This is not permanent, and panicking right now could be one of the most expensive mistakes you ever make. Let's look at what experts are actually saying, because it's very different from what the headlines make it sound like. Fannie Mae and the Mortgage Bankers Association are both forecasting rates to drift back toward 5.75 to 6% later in 2026 as the conflict potentially de-escalates and oil prices stabilize. Jeff Dergarahian, the chief investment officer at loanDepot, said clearly, without the geopolitical tension, the 10-year Treasury would be well below 4% and mortgage rates would be in the high fives right now. In other words, the war premium is real, but it's temporary. The underlying economic trajectory was pointing toward lower rates, and it will likely resume pointing there when the conflict eventually resolves. So what does that mean for you right now? If you are James, if you are someone who is ready to buy and suddenly finds yourself recalculating whether you still can, here's what you need to understand before you make any decision. First, waiting is not free. Every month you wait, you are paying rent that builds zero equity. You're missing potential appreciation on a home that could be worth more by the time rates fall. And if rates do fall back to the high fives later this year, competition from millions of other buyers who are also waiting will flood back in simultaneously, driving prices up even as rates come down. Waiting for the perfect rate is a losing game because the variables that move rates, geopolitics, Federal Reserve policy, oil prices, global capital flows, are genuinely unpredictable. The cost of waiting is not zero. Second, if you are already a homeowner who is planning to refinance, this is not the moment to panic either. The window below 6% closed faster than anyone expected, but it closed temporarily. If your current rate is above 7%, which many people who bought in 2023 and 2024 are sitting on, a refinance opportunity at 6 to 6.5% may still save you meaningful money every single month. Don't wait for perfection when good enough saves you $300 right now. Third, and this is the mindset shift that separates people who build wealth from people who stay stuck, stop letting global events you cannot control paralyze decisions you absolutely can control. You cannot control what happens in the Strait of Hormuz. You cannot control what Jerome Powell says at the next Fed meeting. You cannot control oil prices. But you can control whether you are financially ready, whether your credit score is optimized, whether your down payment is positioned, whether you understand the market clearly enough to move decisively when the window opens, instead of being caught unprepared again like so many people were in February. Here's the full picture in simple terms. A war in Iran caused oil prices to explode. Exploding oil caused inflation fears to spike. Inflation fears caused bond investors to sell. Massive bond selling meant yields to surge, and surging yields meant mortgage rates jumped for 5 straight weeks. And those 5 straight weeks pushed James's monthly payment up by $115, his lifetime cost up by $41,000, and his dream back to the starting line. That is not James's fault. That is not your fault. The financial system is deeply interconnected in ways that most people are never taught to understand. But here is the truth that changes everything. The people who understand these connections, who see the chain reaction clearly instead of just feeling the pain at the end of it, are the ones who make better decisions, who move at the right moments, who don't panic when headlines scream and don't freeze when opportunities appear. James's story doesn't have to end with him still renting 5 years from now. It ends with him understanding the system well enough to navigate it and finding the window when it opens. Now you understand the system. The window will open again. Make sure you are ready when it does. This is Albert, and I will see you in the next one.